Welcome back. Well, we are, of course, in the thick of U.S. earnings season, and while big U.S. banks reported mostly upbeat earnings, our next guest says we shouldn't get too excited. He believes the banking crisis is not over yet and that markets are in for an aggressive correction. Let's bring in Raymond Bridges. He is managing member at Bridges Capital. Raymond, thanks a lot for joining us. You are focused on loans that need to be repaid by, I believe you're going to focus on the regional banks, many of the regional banks in the U.S. here, loans that were extended by U.S. authorities during the worst of that crisis in March.
Yeah, Paul, I want to thank you for having me. So the main focus, really, what we're looking at is back in March when the Federal Reserve stepped in with the Bank Term Funding Program and the subsequent loans to the FDIC through the failed banks of Silicon Valley, First Republic, and Signature Bank. They increased their balance sheet and to the tune of roughly $300 billion through that process, and that reversed the Fed's policy action. Previous 12 months, the Fed balance sheet was roughly $9 trillion and brought it down to, on the asset side, down to roughly 8.3 trillion, and reversed that just in a very short period of time to the tune of 300 billion. That has worked its way out of the Fed's balance sheet on the asset side, but the loans are still there. So it's down to about $260 billion in the Bank Term Funding Program and the FDIC loans to the failed banks that are in receivership. But if you look at the Bank Term Funding Program, it continues to be accessed. This is a 12-month program by the Fed. So this isn't quantitative easing, but it was liquidity into the marketplace. I would argue that that is one of the reasons why we've had this extended rally, this extended bear market rally since March. We're at almost a 50% retracement level in the bear market rally from October to March timeframe, right when this crisis occurred. And Powell stepped in and did something different than normal. I would argue that if he didn't do that, we would have had a capitulation phase, kind of rip the Band-Aid off this late cycle of environment that we're in right now, and we could get back to sustained growth. But he kicked the can down the road, saved the banking crisis. It might prove out to be the best situation, but that's yet to be seen. Banks continue to access that Bank Term Funding Program. Just earlier this week, we had PacWest, the Bank of Canada merger, or Bank of California, merger. And, that's just one other aspect. All these loans have to be paid back with an interest rate roughly of around 5%.
So this is you see this as a liquidity story. Liquidity was injected into the U.S. economy during that period of rescue. We heard a lot about banks not being able to lend as much to their clients. You think that situation is going to be made worse when these loans get repaid. Is that correct?
It continues to be worse. The higher for longer mantra of the Fed, we're in that era right now. So there is a real economy out there that's affected by high interest rates, cost of capital to businesses that need to rely on the capital markets to finance their growth. Individuals need financing, buy used car prices, things like that. So there is a real economy that's affected with this higher for longer mantra. And the Fed, Powell just put a kind of a insight into his thinking just 2 days ago when he mentioned that he doesn't see inflation to 2% until 2025. The labor market's also very strong, so that gives him cover to stay aggressive and keep his focus. If you think of the dual mandate, which is stable prices, is with maximum employment, those are his two focuses. Well, we have maximum employment here in the U.S. Labor market's been strong, so he can focus on that stable prices and possibly even overshoot it a little bit.
So you see an aggressive stock market correction coming, and moreover, you say that when it comes, you and your colleagues at Bridges Capital are going to substantially remake your portfolios in favor of a heavier equity weighting. Tell us about that.
Yeah, so we also have the Bridges Capital Tactical ETF traded on the NASDAQ. That's a way to access the strategy. It just launched recently here in May 11th on the NASDAQ, but it takes advantage of the process that we use. It's really a two two-pronged process with a macro thesis that changes less than annual. That thesis has been bearish since the Fed changed policy at the beginning of 2022, late 2021, and started focusing on inflation. It's remained bearish. And then there's a second prong to the strategy that takes advantage of a technical breadth, volatility, and sentiment analysis that is becomes contrarian at extremes, but then does follow the trend when the market is rallying. So, for example, the process was very bearish starting in March and April of this year, and has been scaling off. However, in December, we were about 90% invested in equities, U.S. equities, from December till about March timeframe, and then we've been scaling off into this rally right now. Buying treasuries right now, it's 5.4, 5.6 for 3 months, 6-month T-bill. That's an attractive rate. As new money comes into the market, if we get a couple more rate increases, and you can get roughly 6%, right? 5.75, 5.65 in a 3-month, 6-month T-bill with no volatility, and the equity markets already rally 30% from their lows in October. New money is it's going to look a lot more attractive for this low volatility treasuries, and that's where we're placing our capital right now for preservation, looking for more of a capitulation and the Fed to change his focus from stable prices to more of increasing employment, which we haven't had that employment flush out yet.